On the last night of September 2008, the lights stay on in government buildings on Merrion Street in Dublin. The streets outside are ordinary. The decision inside is not. Lehman Brothers has been dead for 14 days. Wholesale credit has stopped behaving like money and started behaving like a rumor. Irish bank shares have been collapsing through the month. Anglo-Irish Bank is sliding toward the edge. Funding lines that rolled every night are no longer rolling. The people in the room hear a warning that sounds like science fiction until it does not. If one domestic bank cannot open, the others may not survive the morning. A run no longer needs a queue on the pavement. It can finish a country on a screen. Before dawn on the 30th, the Irish government announces a blanket guarantee. Deposits, senior debt, dated subordinated debt, 6 domestic institutions. The liability attached to that promise is 400 billion euros. 400 billion euros is more than twice the gross domestic product of the Republic of Ireland. The state does not pay the sum that night. It does not possess the sum. It does something colder.
It signs the Irish name under private claims it has not audited, cannot value in a frozen market, and could never meet if the loans behind them are dead. That is the contradiction. A sovereign smaller than many global banks agrees to ensure a banking system swollen by euro area credit. Officials believe they are buying time and stopping panic. They are also turning hidden property losses into a contingent claim on every household that pays tax in Ireland. By morning, Irish bank shares jump. London and Frankfurt stare. The credit institution's financial support scheme will be rushed into law. Almost no one in that cabinet room yet holds a true mark on the loan books now wrapped in the state's credit. Can a country the size of Ireland legally insure private debt twice its own economy and remain a solvent state? The night answers yes. The years that follow will test whether the answer was a policy or a suicide note written in legal language.
The Ireland that sat down to that meeting did not look like a candidate for national insolvency. Through the 1990s and into the 2000s, it had been sold as the Celtic Tiger, an English-speaking platform inside the European Union, a magnet for American pharmaceutical and software plants, a place where unemployment fell from the despair of the 1980s into something that felt like a different country. In January 1999, Ireland entered the euro. The political story was belonging. The financial story was the price of money. Households and developers who had once borrowed at rates that priced a small open economy and a history of devaluation now borrowed at rates set for a union dominated by German inflation. Mortgage rates fell. Credit stopped being scarce and started being weather. Banks industrialized the weather. Allied Irish banks and Bank of Ireland chased volume. Anglo-Irish Bank, once a specialist minnow, became the house lender to a tight circle of large developers.
Irish Nationwide Building Society, the Educational Building Society, and Irish Life and Permanent followed the same collateral: land, houses, offices, hotels, and the faith that those things only rose. From the mid-1990s to the peak around 2006 and 2007, national residential prices rose on the order of 300%. Average new homes in Dublin moved from sums a teacher might imagine to sums that required 2 incomes, interest-only products, and another 10% next year. Construction and related trades swelled toward 1/5 of output. Cranes became a folk index of success. Retail deposits could not fund that speed. Irish banks sold bonds into the euro market and borrowed from other banks overnight and for 90 days. International investors wanted yield in a currency Dublin could not devalue. They treated an Irish development loan as a cousin of a German-covered bond. It was not. Loan-to-value ratios loosened. 100% mortgages appeared. Development finance was rolled on the hope that the next site would sell before the last one had to be written down. A handful of developers carried tickets so large that one failed Docklands Tower could dent a lender. Anglo's book was concentrated enough that relationship banking became a polite phrase for correlated risk. By 2007, domestic bank assets stood at a multiple of national income unthinkable when Ireland still printed its own notes. Private credit relative to output exploded. Conference speeches called this sophistication. It was leverage. Outsiders missed the composition. This was not a globally diversified book with an Irish branch network. Commercial property, land banks held for planning gain, and mortgages written at the top
top of a local cycle sat at the center. When American and German credit tightened, Irish collateral would not hedge the shock. Every major domestic lender had made a version of the same bet. Official Ireland had reasons not to stop. Stamp duty and building jobs filled the budget. Builders were employers and donors. The financial regulator, in a culture later inquiries called excessively deferential, ran stress tests that assumed modest price falls. Capital rules treated home loans as safe.
Light touch supervision was the fashion of the decade, applied to a property market far too large for the sovereign that hosted it. The first cracks were dull. In 2007, interbank spreads widened. Builders whispered about unsold units. In March 2008, Bear Stearns was forced into JP Morgan. Irish funding costs jumped. After Lehman, the wholesale window did not narrow. It slammed. Property deals froze. Paper billionaires could not roll loans against sites with no bids. Banks that looked liquid on an accounting date became desperate on a cash date. Liquidity is confidence with a due date. When it arrived, the miracle revealed itself as a carry trade, cheap euro money, local land, and the unstated hope that someone else would keep buying. The blind spot was not a housing boom. Booms are ordinary. It was a sovereign that did not set its interest rate, a banking system whose liabilities had outgrown the state, and a political class that treated rising prices as an achievement. The mismatch was already on the books. The night in Dublin would not create it. The night would put the public underneath it.
In the center of the room sit two men who share a first name and a problem that will outlive their party. Brian Cowen is Taoiseach. He came up through Fianna Fáil, spent years as Minister for Finance during the boom, and inherited the office from Bertie Ahern in May 2008, just as prices were already turning. He also knows what a failed Irish lender would do to a government that had spent a decade taking credit for the miracle. Brian Lenihan is Minister for Finance, in the job only since that same May. He is a barrister by training, the son of another Brian Lenihan, and he has been in office long enough to smell the panic and not long enough to have designed the boom. Colleagues will remember a man trying to master a balance sheet in real time. The brief is already eating the calendar. Around them move the permanent state. John Hurley, governor of the central bank. Patrick Neary, chief executive of the financial regulator. Officials from the Department of Finance who never expected to underwrite developers. Bank chief executives are summoned. Lawyers draft through the night. The Attorney General is asked whether the state can even do what the bankers demand.
The bankers, especially at Anglo-Irish, insist this is liquidity, not solvency. If the state stands behind them, wholesale markets will reopen, deposits will stay, and the property loans will perform once confidence returns. It is the oldest plea in a crash: time and a public signature. The regulator has practiced light touch for years. A confession that the banks are undercapitalized would admit the watchdogs missed a bubble in a country small enough to walk across. The incentive is to treat the night as a run, not a reckoning. Cowen's government fears a political contagion. Ireland cannot print euros. It cannot let a domestic bank fail on a Tuesday and pretend the others are unrelated. There is no living Irish resolution law built for this. Dublin's instinct is the opposite. Wrap the system so Ireland is not the first euro area state to open a bank coffin. Lenihan's need is more immediate. He needs the doors to open at morning. He needs the European Central Bank, still unwilling to be a fiscal backstop, not to watch an Irish lender miss a payment. He needs senior bondholders not to bolt, because those bonds are the plumbing.
A deposit-only shield might not stop a wholesale strike, so the draft grows. Households, institutions, senior debt, dated subordinated paper. There is ambition in it and fear. Ambition, the first mover whose banks look safest in Europe by breakfast. Fear, that Anglo is already a whole, that the whole is shared, and that a precise rescue would require numbers nobody in the building actually has. No one in authority wants to be the person who let an Irish bank die at sunrise without knowing whether the death was containable. In that vacuum, the largest possible promise feels like the smallest possible risk. It is not. But the men who must sign cannot see the loan files in the dark, and the files, even in daylight, still carry yesterday's prices.
The meeting does not end with a speech. It ends with a text. Through the small hours of the 30th of September, drafts move between the Department of Finance, the Attorney General's office, and the banks. The instrument is blunt on purpose. Covered are all deposits, covered bonds, senior debt, and dated subordinated debt of the 6 Irish-controlled institutions. The window is 2 years, to the 29th of September 2010. It is still dark when the announcement goes out. At sunrise, Irish bank shares spike. Depositors who might have queued stay home. For a few hours, the bet appears to work. Dublin has bought the one commodity every crisis consumes, a mourning. Then the rest of Europe answers. What Ireland called a shield is read abroad as a raid on deposits. The European Commission will later clear the scheme as state aid, with conditions. Clearance is not applause. On the 2nd of October, the Oireachtas rushes through the Credit Institutions Financial Support Act. Law catches the night. The legal fact is now this: the Irish public stands behind private paper it did not issue. The first wound is informational. The promise does not reopen honest books.
It removes the immediate death of the banks and delays the autopsy. Managers still extend and pretend. The state has underwritten the delay. December brings a rupture inside Anglo's story. Reports show that Sean Fitzpatrick has for years shifted millions in personal loans off the bank's books at year-end, parking them with Irish Nationwide, then rolling them back. The chairman resigns. The hidden loans are not the entire whole. They are a tell. The culture that demanded a public blanket did not keep public books. On the 15th of January 2009, the government nationalizes Anglo-Irish Bank. The supposed liquidity event is now a corpse. Shareholders are effectively wiped. The state owns a bad bank whose losses are still being discovered in slow motion. Recapitalizations follow for allied Irish banks and Bank of Ireland. Preference shares, then ordinary equity, then more. Each round is sold as sufficient. Each round meets a new impairment. The guarantee stops counterparties from running. The capital tries to fill a pit whose floor keeps dropping. In April 2009, Lenihan announces the National Asset Management Agency.
NAMA will buy the large land and development loans, paying with government-backed securities, in theory to clean bank books and restart credit. The haircuts look harsh in the doll and still prove kind against later prices. Moving a bad loan from a bank to a state vehicle does not delete the loss, it relocates it. House prices keep falling. Peak to trough, Irish homes drop on the order of 50%. Commercial property falls harder in the wrecked estates. Unemployment climbs toward 15%. The budget, once fed by stamp duty and building wages, becomes a deficit that would be ugly even without the lenders. With them, it becomes existential. A sovereign collects taxes from wages, spending, and profits. Those taxes are a slice of output. Output has just been revealed as swollen by building that will not return. Against that tax base, the state has pledged to keep whole a system whose property wreckage is not a rounding error. Anglo alone will absorb on the order of 30 billion euros of public money. The broader recapitalizations and promissory note machinery will push the gross fiscal cost of the crash towards 64 billion. The overnight promise does not require the full insured stock to be paid in cash. A realized fraction of a multiple of national income is enough to break a small treasury. Promissory notes become Irish plumbing. To fill Anglo and Irish Nationwide, the government writes IOUs the Central Bank of Ireland can treat as assets. It is a method for funding a dead bank without dumping the same sum onto a hostile bond market in one afternoon. It also pulls the central bank, and through it the euro system, into a national disaster. By 2010, the original theory is spent. Markets no longer price Irish sovereign debt and Irish bank debt as separate things. They have been taught not to. Yields on government bonds explode. A bank funding emergency is now a sovereign funding emergency. The state that backstopped the lenders cannot cheaply fund itself. In September 2010, the 2-year blanket expires into narrower, costlier schemes. Innocence does not return. Anglo's losses keep arriving. Allied Irish becomes majority public. Irish Nationwide is steered toward the same grave as Anglo. November is the climax, the night made possible. On the 21st, after days of denial in which ministers speak of sovereignty as if it were a cash reserve, the government confirms talks toward a program. On the 28th of November 2010, Ireland accepts an €85 billion package from the European Union and the International Monetary Fund. Part of that sum is Ireland's own, taken from the National Pensions Reserve Fund and cash balances. The country is, in part, lending to itself under foreign supervision. The rest comes from the IMF, the European Financial Stability Mechanism, the European Financial Stability Facility, and bilateral loans from the United Kingdom, Sweden, and Denmark. The program is credit with a memorandum. Budgets must be cut. Taxes must rise. Lenihan negotiates while already fighting the pancreatic cancer disclosed in December 2009. Cowen's government will collapse into an early 2011 election that wrecks Fianna Fáil. Austerity is not a slogan. Public pay is cut. Welfare is squeezed. Projects stall. Young people leave in numbers that recall the Ireland baboon claimed to have closed.
The wound is the discovery that a legal signature made to stop a queue that never fully formed has transferred land speculation onto hospital lists and tax bans. Ireland, inside the euro, inside the promise, inside a program, has little room to experiment. The Knight's logic was to protect funding markets. The year's logic is that those markets, once saved, still send the invoice to a state that cannot print the currency on the invoice. Bond ratings fall, budget day crowds fill the streets, and the word sovereign starts to sound like a joke told in a very expensive room. A bank run is a race against time. A sovereign guarantee is an attempt to stop the race by moving it onto a slower clock, the clock of tax years, bond auctions, and elections. Ireland proved that the slower clock still arrives, and that it can break the thing that was supposed to be permanent. The larger principle is not that bankers are villains, though some were reckless, and not that ministers are fools, though they signed in the dark. The principle is arithmetic wearing a flag. A state is a tax monopoly, with an army, a court system, and, if it is lucky, a currency. Ireland had the first items. It did not have the last. It then attached its name to private liabilities born at euro interest rates, on local land, in institutions whose internal culture treated land as destiny. Contingent liabilities are seductive because they do not appear on day one as cash leaving the treasury. They appear as confidence. Markets like confidence. For a morning, confidence is cheaper than recapitalization. The aftertaste is that confidence, once written into statute, becomes a political obligation to make the numbers true. If the loans are bad, the statute does not float. It sinks, and it takes the signer with it. There is a reason old banking law obsessed over double liability, over clearinghouses, over the difference between a deposit and a speculation. Those distinctions are boring until the night they are ignored. When a government erases them in a single instrument, it is not only protecting households with savings, it is protecting wholesale lenders who priced Irish risk as if a small republic were an implicit parent company. Europe learned a partial lesson and refused a fuller one. Later years brought new resolution tools, bail-in language, and a banking union still incomplete. Ireland exited its program, regained market access, and watched a new cycle of foreign capital and domestic housing stress return in different clothes. Recovery is real. Erasure is not. The generation that emigrated, the public pay that was cut, the hospitals that waited remain part of the balance sheet, even when the bond yields do not. Stand on the Liffey at dusk, and the offices look ordinary again. Cranes come back. They always do. The remaining puzzle is not that property booms. It is that a democracy can be persuaded in a single sleepless sitting to place the full faith of its people under loan files it has not read, at a scale its taxes cannot feed. Intention was survival until breakfast. Outcome was a claim on a decade. Allegation, in the bitter years, said the night was a banker's coup. Fact says the night was also a failure of measurement. No independent, brutal mark-to-market of land before the signature. Scenario said that without the blanket, Ireland would have been a second Iceland in the euro, with ATMs dark and trade seized. That scenario cannot be rerun.
It can only sit beside the invoice that was rerun year after year in budgets. The haunting is specific. Somewhere in those government buildings, the legal words still exist. The scheme, the act, the fees that never could price the risk. The files remain. So do the names. Paper is cheap. Sovereignty, it turned out, was the expensive item on the table. If a state cannot print the money of its banks and cannot value their land at 3 in the morning, who exactly is being protected when it signs anyway?